Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Arthur Cohen, who's the founder of Arthur Cohen Insurance, and we'll be talking about annuities. Arthur, welcome back to the program.
Thanks, Mike. It's a pleasure to be back with you.
Yeah, I've been enjoying our talks and really getting some great value from that. And I know that if someone says the word annuities, you might get 2 or 3 different answers, and sometimes there's misconception. So let's start with defining what is an annuity.
Well, thanks for asking me that, because sometimes annuities have a negative connotation. I don't know what's happened, over the years before I was in the business, and I'm in the business for over 40 years. But in my mind and the way I do retirement planning, annuities are a really, really important and valuable piece of safe money, not stock market money, not money that you have exposed to risk. This is a way of making sure that your future is taken care of. We take money off the table, we lock it into certain kinds of annuities, which I guess we'll talk about, and make sure that not only can you not outlive the benefit from the annuity, but it's a safe haven, a place to park your money to make sure that it's safe.
I always love simplicity, and I think when you confuse, you lose. And I like what you just said there, and we're gonna dive into some different examples of annuities and things. But a couple of the things that jump out at me is, safe and secure, because so many times I feel like people are like, hey, I've been in the market, the stock market for decades, and man, every time I open my email or my charts or my statements, feel like I get the wind knocked out of me because my portfolio's taking a hit. And when you are talking about safe, now we're talking. And I really feel like that right there is going to be such a huge win for people, is to learn, let's talk about where I can put my money to have safety, because they're so not used to that, So we defined what an annuity is. What are some different types of annuities that people should be aware of?
Okay, well, so, just to take it one step further, annuities definitely need to be part of your strategy as you move into retirement. Not for all of your money, but again, just the money that you want to be safe. So I've been in the business for quite a while, and I used to have my Series 7 license like maybe 40 years ago, and I decided that's not for me because it's too risky, and when people lose money, I feel bad. I don't want that to happen. So that's why I only do fixed guaranteed annuities. So there are 3 different types that I could talk about. There is a multi-year guarantee annuity that's like a CD from the bank. And the interest rates that we provide are commensurate with whatever banks are offering. The big difference is that because it's offered by an insurance company, the interest that you're earning is tax deferred. So some people refer to it as a triple play, to use a baseball term. You're earning interest, again, usually commensurate to a CD. It's compounding because you're earning interest on your interest. And you're also earning interest on the amount of money you would have paid in taxes. So that's one way of looking at it. And you could be locked into a rate for 2, 3, 4, 5 years or more, and the rates are guaranteed. So it's a great place to park safe money. Okay. Then I'm giving it to you in a nutshell. I mean, I could elaborate as much as you want, but then there's an index annuity. Here's how it works. How'd you like to participate in the gains of the stock market, but not participate in the losses? And by the way, we don't charge fees. Stockbrokers charge fees. We don't charge fees. I get paid by the insurance company. So if somebody reallocates or repositions $100,000, let's say, the full $100,000 goes to work for you. And if you participate in the gains of the market but not participating in the losses, I know this sounds too good to be true, but what's the catch? Well, so, there are participation rates and caps on how much you could earn. So you're not going to hit a grand slam and you won't have huge increases, but you're guaranteed not to have any losses. Again, it's about the safe money. So I
Hmm.
like to say when the stock market does well, my clients like me. But when the market tanks, my clients love me
Love me.
because
Right.
they don't participate in the losses, you know?
Yeah.
Okay. And then there are income annuities. Um, Here's what an income annuity does. You know how Social Security or pensions give you income for the rest of your life that you can't outlive? The only other
Yeah.
way to add to that is with an income annuity from an insurance company. We reposition a lump sum of your money and turn it into a guaranteed income stream that you could either turn on immediately, that's called a SPIA, single premium immediate annuity, or at some time in the future, that's called a deferred income annuity or a DIA, or uh, there could be combinations of an index annuity with a deferred annuity that turns on an income. Um, and the thing is, um, in a nutshell, we convert wealth into income. People who know that their bills are going to be paid every month for the rest of their life have less stress and a greater enjoyment of life.
Yeah.
So, with these products, we help plan for your future retirement, and we don't utilize all of your savings, just the amount that you want to be safe.
You mentioned about safe and guaranteed, and I'll bet you that there's some people that have gotten into an annuity and years go by and their friends are like, look at my returns I got in the market and it's huge returns, and they're looking at their annuity going, well, mine's not all that great. But then when the market takes a dump, then their friends go, uh-oh, my portfolio is horrible, and then your clients are like, yep, but mine's great. And I think that,
Well, yeah.
some people want that upside, that excitement. But you give me steady Eddie and like the tortoise and the hare, give me the tortoise, and I want safety and security.
Well, so, and to take that one step further, let's talk about baby boomers, for example. Over 11,000 people are turning 65 every day, and
Mm,
two-thirds of them aren't set up for their retirement. And, I feel
wow.
like I'm on a mission to educate the public about safe and sensible retirement planning. And what you mentioned, if somebody is in the stock market versus somebody who's not, and they want to start taking money out for their retirement. If you're taking your money out while the stock market is down, what that's referred to as a sequence of returns risk. I'm using air quotes like you do. Sequence of returns risk. So if the market is down and you're taking money out, you're going to, you know, you're going to run out of money because it can't last the rest of your life
Mm,
if you're fortunate enough to live a long life. One of the things that I've heard is, you know, what's worse than dying too soon? It's living a long life and running out of money. Think of
mm.
that. So we want to take that longevity risk off the table by using annuity planning.
That's a huge, huge mindset shift, I think. And I also think this, um, and you've touched on it, but I'm going to ask this question.
Uh,
Um, so all of this sounds great, Arthur. So I've got all of my money that I can put into annuities, right? So I'm going to put 100% of my retirement. Of course not, but how much money? What percent should you allocate to annuities?
I like that question because, oftentimes I get the question, what portion should I use of my money?
Yep.
So there's a very simple common sense, and what I like to talk about is common sense. Rule of investing, and it's called the rule of 100. You could Google it. The rule of 100 is a common sense retirement planning tool that helps you determine how much of your portfolio should be subject to risk and how much should be safe. And it's so easy. You take your age and you subtract it from 100. So if you're 60 years old, you take your age, you subtract it from 100, and in that case, only 40% of your savings should be in the stock market. 60% should be in safe products like annuities.
That's a really, I like, again, like I mentioned to you a while back, I like simplicity, and that sounds simple. You take your age minus 100, that's the percent
There you
into
go.
the stock market, and then the rest can be put into a safe vehicle. So I'm hearing you say things, and I'm thinking as a consumer, I'm thinking questions. And so here's one that's probably like a strategy question, but
Uh,
are there types of annuities that you can set up with after tax money? So I know that sometimes you would say, oh, look, let's roll your old 401k into an annuity. But can you set up an annuity with after tax money where you've got it sitting in a savings account, and I just want to
Oh,
start an annuity
absolutely.
with that? Okay.
Yeah, not only that, we could do it with after tax money or before tax money. So if
Yeah.
somebody has a 401k, for example, that's what we, call qualified money or an IRA, we could roll that without any tax consequences. We just do a transfer into
Mhm.
an annuity, and that way you're not subject to risk anymore. We make sure you're locked in, and the money is going to last the rest of your life. So that's a great question. You could do it with before tax money or after tax money.
Yeah.
And, the reason the rule of 100 makes so much sense is, if you're 20 years old, you have time on your side. The market
Yeah.
goes up, it goes down, it goes up, it goes down. But when you're 70 years old, you don't have the tolerance for those ups and downs
Yep.
anymore. So all the more reason why we need to make it safe.
And even let's just use that example of 70. That means that you could have 30% of your money into the market. And even though that is the calculation of the rule of 100, you might find that 70-year-old going, that's fine and good, Arthur, but I want 100% of my money in something safe that can't lose money. So it's just a thought and a recommendation. I'm certain that you would never
Right.
say to a client, you must do this, you must do that. You're just giving guidance.
Yes, yes. Everything has to be, everything has to make sense for the particular person, the particular situation. And, again, we bring into play the beneficiary designations. It should the income only be for your life or your life and your
Mhm.
spouse's life, if you predecease your spouse. So all these things are taken into consideration when we do planning and we design a program specifically for that need.
I think that's and I want to just kind of go back to a point you were making before, based on need. You might have let's call it a chunk of money, that you can put into an annuity, and like you were saying, like some can give income stream, some can give growth. How do you how do you ascertain what type of annuity the client would need given their stage of life? So I might have a chunk of money and I don't need the cash flow right now. I just want to know that it's safe. But you might have
Right.
someone else that goes, I've got this chunk of money and I need to know that I'm getting X number of dollars per month. How do you determine that?
Right. So you kind of answered the question in your question because it's up to the person to help me decide
Got
what
it.
makes sense for them. So if you know that your mortgage is paid up, but you want to have, $5,000 a month for expenses, and you already have 3,000 a month coming in from Social Security, so we need an
Mhm.
extra $2,000 a month, and I work backwards
Yeah.
from and solve that way to see how much we need to reposition to create that kind of income stream. That's just one example of how we do it.
And I love that because that makes me think of the word gap, GAP. So when you're working backwards and you need X number of dollars per month in your retirement, and then you only have this much coming in from whatever sources, well, here's the gap. Well, how do we close the gap? Well, one way is the safe and secure guarantee annuity, put X number of dollars in. We have to do that calculation. But I want to ask you a question about that gap because I feel that some people would go, oh, here's what I need in retirement, this number right here. But you might look at it and go, yeah, but did you consider this? Did you consider this? Did you consider
Right.
this? Meaning,
Right.
you like when you're working 40 hours a week or more, you might not have the time to go and travel and do this and spend in hobbies. So you might assume you need X number of dollars in retirement, but it might be an actual higher dollar figure because as you are retired, you've got more time to go out and spend.
That's true. And also, some people might want to slow down and not spend so much. So
Yeah.
again, it depends on the situation, and what we need to take into consideration also is inflation. So do we create an income stream that increases as time goes by, or are you okay with keeping it at a level amount? And that also takes into consideration a person's age. What's the life
Yeah.
expectancy? What's your health? What's your family situation? And so, we look at things holistically and come up with a solution that makes sense, that fits your philosophy as well as your budget.
Yeah, that makes total sense. And I think if someone, really took a look at this, well ahead and just thinking, how do I kind of allocate my funds? And here's my age and all of all these things we've been talking about, an annuity can be a very solid, safe, secure decision for a specific percentage of your retirement funds, not everything. So I think
Sure.
if someone is interested in what we've been talking about, Arthur, what's the best way that they can learn more and then also reach out and connect with you?
Well, a great way to reach out is by going to my website, arthurcoheninsurance.com, or my phone number is area code 305-595-0001. I was lucky enough to get that phone number about 45 years ago.
And you kept it.
It's easy to remember. Yeah.
Perfect. That is so
Okay.
awesome. Well, Arthur, thank you so much for coming back on. It's been a real pleasure talking with you.
Thanks, Mike. Likewise.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.